Hello, this is Eric Parnell, Chief Market Strategist from Great Valley Advisor Group, and we're here today with our latest market insight. Joined once again by Evan Coffey, investment analyst on the team. So, Evan, what are we going to talk about today?
Well, Eric, it's great to be back on Market Insights, and we're through the first quarter, but I have to say it was a bit of a rough one for investors between a sell-off in the software sector, credit rumblings, and an energy crisis stemming from the situation in the Middle East. There was a lot to deal with, and it felt like, really everything went wrong, or at least everything that could go wrong did go wrong. But yet here we are today, middle of April, and we're sitting near or at all-time highs in the S&P 500 and the NASDAQ. Now, before we get into this most recent equity rally, I want to start with the situation in the Middle East and the latest developments. Last Friday, Iran's foreign minister announced that the Strait of Hormuz was open for business and commercial shipping would be allowed through the strait. President Trump responded to this statement by saying, hey, we're going to keep our U.S. naval blockade in place as well on all Iranian ports. And it was kind of a tit for tat situation. But even with these conflicting reports, oil dropped pretty significantly and stocks rose higher. We saw all three major indices up more than 2.5% for the week, and oil settled into about $80 to $85 a barrel. It really did feel like we had taken 2 or 3 steps forward with this situation, and there was light at the end of the tunnel. But as we've learned, with the current administration and just this situation, we can't get ahead of ourselves. Over the weekend, the U.S. seized a ship in the Gulf of Oman. It was an Iranian ship, and it was reported that Iran was firing at ships in the Strait of Hormuz. This was prior to what would have been peace talks taking place this past Monday, but those we now know did not happen. J.D. Vance did not travel to the Middle East with his team. And Iran kind of responded to this ongoing U.S. naval blockade by saying, hey, we're going to continue to fire at ships in the strait. So, then we flash forward to yesterday, and we have President Trump announcing that the U.S. will extend the ceasefire with Iran and continue the blockade of the country's ports until he receives a unified proposal from Iranian leadership. As I said, J.D. Vance and that negotiating team did not travel to the Middle East. And just this morning, about an hour ago, we got reports that Iran had fired at 3 ships in the strait once again. So it's an ever-evolving situation, but it seems like markets, specifically equity markets, really don't care. And so that's my question to you is, it feels like we've priced in this is all but rectified over there. And yet the reports are not saying that. So do you think that we're getting ahead of ourselves? Do you think that this, latest run in equities is justified?
Yeah, it's a great question because the situation in the Middle East, it's not going away. I mean, it's like they say with the Middle East, you can get into a conflict pretty easily in the Middle East. It's hard to get out. And the situation in Iran, it's going to continue to unfold in the coming weeks and the coming months. And it's really, it remains unclear in terms of exactly how it's going to resolve itself. But one of the things that's important for investors to remember is that there is a key distinction and a key differentiation between geopolitical uncertainty and financial market uncertainty. We saw the stock market fall from just over 7,000 at the end of January to as low as 63.16 at the end of March. And a lot of that decline took place during the month of March when the Iran conflict was first unfolding. But once investors got a sense of confidence to say the financial market uncertainty associated with the situation is largely resolved, it made up all of that decline and more in less than half a month. And that gets to a key point about investors that they should always remember when it comes to managing their investment portfolio. Stick to your long-term discipline and stay focused on the fundamentals. The geopolitical situation in Iran is going to continue to be uncertain, but the fact of the matter is that the underlying fundamentals for this market remain as strong, if not stronger, than they were before the Iran conflict. We have economic growth that's projected to be positive through the remainder of 2026. We have inflation expectations, despite the spike in oil prices, that continue to remain well under control at less than 3%. And we have corporate earnings. Corporations raised their earnings forecasts during the Iran crisis. They had all the reason in the world to cut their earnings forecasts, manage investor expectations. Instead, they raised earnings forecasts during that conflict The underlying fundamentals to help support higher stock prices is strong. And if anything, this is a market that's getting back on track after a couple months to start the year.
Yeah. So I want to get into, as you said, the market getting back on track. We had a tumultuous first quarter. Everything was in the red leading up towards the end of March. But like I said previously, we're now sitting at near at all-time highs. We're up today on the S&P 500 and the NASDAQ. Equities have staged a major comeback after stumbling out of the gates. Just to put some data on this, the S&P 500 through yesterday, April 21st, was up 7.43% for the month of April. The NASDAQ up 11.08%, and the Dow Jones Industrial Average up 5.55%. On the international front, the MSCI EAFE is up 4.79%, representing developed markets. And on the emerging side, we're up 9.8%. These are all numbers just for the month of April. Small caps, as measured by the Russell 2000, they hit an all-time high, and the index is up more than 11% in the month of April. So, yes, we're going to see residual effects of the conflict in the Middle East, as you said. We'll need to continue to monitor Q1 earnings for any preliminary communication and signs that there could be bleaker outlooks. But again, as you said, that hasn't been the case. So outside of some continued one-off idiosyncratic risks, equity markets are looking through the noise, just as they've done with every other short-term pullback since 2022. And you could argue that the market paid off buying that 2022 and COVID dips as well. So, this buy the dip mantra is stretching back to 2020 and is in full effect. So my question to you on the equity front is, are we pinning ourselves again to this AI CapEx story? It might not be the run that we had in 23, 24, and 25, but is tech gonna go at this again? But also, should the retail investor be so eager to buy into these dips? I asked these questions because I recently heard that 30% of daily traded volume is now comprised of the retail investor, and household equity ownership is above 50%. So it's no longer this institutional trade in terms of volume, and the ownership dichotomy has shifted drastically in recent years. So the everyday investor is playing more and more of a role in financial markets. But this kind of sounds scary to me in terms of they're not as informed as the institutional investor. They're not receiving that information as quickly, but yet they're jumping right back into the market when they see noise. So maybe just contextualize this latest run in equities for us. And if you have an opinion on, the retail investor and whether or not they should be jumping back in.
Yeah, no, it's a number of good things to consider. And the first, we had a pullback in the markets that really got, it started in January, but it really got underway in earnest at the end of February once the Iran crisis started to unfold. But really, you can trace the underpinnings to what we're seeing in the market going on right now, going all the way back to the beginning of 2025 in terms of the U.S. versus international and emerging market trade. And really since Halloween of 2025 in terms of the tech trade versus the rest of the market. Is there going to continue to be opportunities in technology? Absolutely. I mean, AI is going to be transformative. And, one of the things that really differentiates what we see taking place in AI today versus the last major technological transformation, which was the internet back 25 years ago, a lot of these companies are making tons of profits. Are we going to start to see a differentiation between winners and losers in the AI space? Absolutely. Because basically there's an arms race that's going on in AI at this point. You have companies that are highly profitable, but they're spending a ton of free cash flow, recognizing, there's going to be winners and losers and they want to be on the winning side. So, when you're blowing through free cash flow and you're spending a lot of money on CapEx, that can start to weigh on the stock price a little bit. But the good news for investors is that if technology starts to slow down a little bit, and we've seen that slowing, particularly since Halloween, there are 11 sectors in the S&P 500, and 8 of those sectors have really not participated all that much in the market upside over the last few years. As a result, they are trading at historically deep discounts, over the last 25 to 50 years. So there's a great buying opportunity. One of the things that we've been seeing since Halloween is a broadening of stock market performance. So many names that, high quality names that have just been largely ignored, we're starting to catch a bid. We saw a break in that during the Iran crisis as that was unfolding. You talk about the buy the dip mentality. If you were an investor who saw what was going on in international markets, saw what was going on in emerging markets, or saw what was going on in some of these other sectors and felt like, hey, I might have missed this. Well, this is your second chance to get in on those names because they're starting to rally, but there's still a lot of potential upside given the valuations that we have. Now, your other point about the retail investor, I see that as a healthy thing. It's, there's certainly an abundance of liquidity that's out there in the marketplace. One of the things it's easy to forget, the Federal Reserve has lowered interest rates fairly meaningfully over the last few years. And that liquidity takes time to work its way into the marketplace. There's an abundance of liquidity and the retail investor is participating in that. It's almost like an increased democratization of investment markets, and that's a good thing. But what that's likely to bring with it is bouts of greater volatility. There was stocks a few years ago that got caught in epic short squeezes. We're seeing that type of activity taking place here again today. That's a sign of the amount of liquidity. It's a sign of the strategic innovation and the nimbleness of some of these retail investors. But it also highlights a point of caution. There is an abundance of liquidity that's in the marketplace right now that can help drive stock prices higher. But if we have any types of conditions that start to unfold, that starts to take that liquidity away from investors, be they retail or institutional, the potential downside to the market could be meaningful.
Yeah, and I think that I'm glad that you touched on the short squeeze point. I know that we were talking about that this morning, and it brings me back to the meme stock era. So we'll see if that continues. But I want to wrap things up today with a look ahead. And, while we discussed the rally in equity markets and we obviously discussed the situation in the Middle East, it wouldn't be a market insights video if we weren't, analyzing what we need to be mindful about and those potential downside risks. As I said, the situation in the Middle East continues to evolve, and we'll keep an eye on that and its ripple effects in energy prices, corporate earnings. But I want to get into some of the other things that maybe you think are certainly important for investors to, as I said, keep an eye on. The tariff situation is not over with. I know that it's taken a back seat. Obviously, we had the Supreme Court ruling where they did rule against the enactment of those tariffs under IEEPA. On the economic backdrop side, things are getting interesting in terms of the start of Fed Chair nominee Kevin Warsh's confirmation hearings with the Senate Banking Committee. I think we each have our opinions on whether or not that will get delayed or not. But what do we need to be, is it the economic side? Is it geopolitical? Is it something more exogenous or idiosyncratic to a specific sector? Is it something that has already taken place in 2026 that we need to continue to be mindful of? Or is there something out on the horizon that you say, hey, this is certainly, could be something serious for financial markets?
No, it's a great question because, one of the things that's great about geopolitics for financial markets is that it provides a wall of worry that markets have to climb. And it can be a good, you have short-term volatility that takes place around geopolitical events or even political events that can help cleanse some of the froth out of financial markets. And we just have to look at the last 4 years. We had a banking crisis in 2023. That was put in the rearview mirror by May of 2023, and the markets rallied through the rest of the year. We had a yen carry trade unwind that took place in August of last year. If you went out for dinner during your August vacation, you might have missed it, but it rallied the market for a few days. Market put that behind it and was off to the upside. At this very same time last year, we had all the concerns about tariffs and quote unquote Liberation Day tariff announcements. Once we hit April 9th and the 90-day pause was announced, the markets were ripping to the upside for the rest of the year. And here we are in 2026. It's the Iran crisis, rattled the markets for a period of time. Once the markets got comfortable with the fact that, the long-term economic implications were not going to be meaningful, it's ripping to the upside. So the question becomes, what is that factor? What is that event? What is the situation that could take place that could truly unwind the strong market performance that we've seen for so many years now? And I think there's two things that investors need to keep their eyes on as we go through the remainder of 2026. The first is inflation. One of the things that we need to be prepared for, and it's not really on the radar screen for a lot of investors right now, the most recent reading for inflation, that headline number started to get a little bit hot. And the core numbers started to show a little bit of signs of heating up. One of the things that we should be ready for is that as we get the readings for March, for April, for May, for June, just due to base effects alone, this number is likely to creep higher in terms of the year-over-year inflation reading. That could start to catch the market's attention because renewed rise in inflation, what we saw in 2022, if that happens in a more sustained way, that is a meaningful downside risk to financial markets. Why? Because higher inflation means that the Federal Reserve may have to raise interest rates, and that's that whole draining liquidity out of the markets phenomenon that we were talking about here earlier. So that's one risk that investors need to watch. The second has to do with the credit markets. We've seen some widening in spreads, which is a fancy way of saying that investors need to be paid more in order to own bonds other than treasuries. That's a sign of risk. If we start to see an increase in defaults and companies going bankrupt as we go through 2026, that's going to be reflected in the performance of the bond market. So, investors like to focus so much on the stock market and signs for risk. We want to monitor the bond market as we go through the rest of 2026, because if we start to see some signs of stress there, that could spill its way over into the stock market as we go through 2026. As we sit here today, all of those indicators look good. But the question is that they continue to look good as we go through the rest of the year.
Yeah. I think that's very helpful for our listeners, just in terms of what to keep an eye on and what to keep in check, as you said, for the remainder of the year. We'll continue to keep a watchful eye on the situation in the Middle East, and hopefully, equity markets continue to rally. But Eric, it's been great talking with you today.
Evan, always great to talk to you. And thanks for joining us for this latest market insight. We look forward to seeing you again soon.